Hi, this is Chuck Oliver. Welcome to Taxes Saved Case of the Week. Super excited to talk to you about a case that going from basically a 30% tax rate down to a 1% tax rate and looking at not just the short-term tax savings, but also the long-term and legacy tax savings. So Davis, let's jump right in.
Yeah, another exciting one. This one more revolved around Roth conversion and a short-term tax savings goal achieved, as well as a great long-term, really exciting long-term tax savings achieved. So I'll go ahead and share my screen. Hopefully everyone's seeing this here. So here on my left, we got the good old tax return for the client, and then on the right, breaking down their situation. So what do we have here? As you'll see, right, we have this client had some W-2 income, right, about 100 grand right here. They had some other interest and dividend income, but the big amount you can see is this IRA distribution, or in other words, the Roth conversion they did of 584,000, and of that 539,000 was taxable, as you see there on line 4B. So on the right, back to it here, what is this income all added up? We're looking at about $640,000 of income. With that, that's going to have a state and federal tax burden of about 186 grand, and you're looking at a 29.1% effective tax rate. So, what do we do here? How do we help this client mitigate the tax? So, you'll see here they used a great strategy called Section 181, which is in film investments. And that's a phenomenal one. It's a 4.25 to 1 tax deduction against active income. So this client outlaid 125 grand into a movie that happened to have Liam Neeson that's coming out later this year. And it generated $532,000 tax deduction and some change, right? And you'll see here on line 8, they had some other income that you see is got to use up a little bit of it, but really they got to use every penny they had of that deduction in the first year around this Roth conversion they reported on the tax return. You see there on line 8, that's that deduction they got to take there. So, what was the overall impact? The impact's really exciting. We took them from, again, that $640,000 of income with $186,000 of a tax burden with a 29.1% effective tax rate. A year after the strategy to $76,000 of income with only an $8,647 tax burden and a 1.4% effective tax rate. So this one had a huge ROI just in first year. Big, huge reduction in the tax rate, effective tax rate there of 27.7% less. First year tax savings, they outlaid 125 to save $177,489 with 142% return on tax. You can see that the first year was exciting, but I'll let you get into, and we'll go over here today some of the long-term tax savings here next.
Yeah, I'd tell you too, it's worth mentioning. What's great is we've got a great network and a great group as you switch us over, Davis, to the long-term effect that we get exclusivity to specific top A list actors for that 181 deduction. So, it's one thing to understand that there's a section of the code of 181. There's another one to know that you've got the right A-list actors and that those are going to be obviously productive and produced as well as high potential of profitability films. So that's just one of a number of strategies. But yeah, let's look at the long-term effect, right? With not only on required minimum distributions, right, like we'll see in this case, but also then what we were able to reduce. So with having this kind of an account value entrapped in regular IRAs and learning from this client that they're averaging about 8% on their return, let's take a look at kind of the long-term effect, especially with them being 63 and they may need to plan for 3 decades of making this money last and not get taxed to death in the process. And we kept rates on sale. So you're seeing the 24% tax rate there if you're looking closely. And we think that's a gift because a lot of people don't realize how much higher they bust through these brackets when they don't get rid of the IRS from their income and their assets. And then they're stuck, right, with taking these large required distributions later in life that ends up impacting them, their legacy, and then the inheritance to their adult kids and grandkids.
Yeah, and I'd echo on top of that, Dad. The other thing that was exciting was how we planned around IRMA, the income related Medicare adjustments that can take place. So by us getting them under that 212 limitation, them in this case being 76 grand, they never had to face that IRMA surcharge on their Social Security. And for these clients, that Social Security check is going to be very, needed for their income throughout retirement.
Oh
So
yeah, it cuts.
a lot of that goes
Yeah,
in.
Yeah, it cuts down on the Medicare Part B and D Medicare premium surcharge, which is another tax, as you pointed out. And ideally, as we get through this, they also, with the majority of their income coming from tax-free sources like a Roth IRA, should not subject 85% of their Social Security from being taxed. So all told, that'll save them probably 12, somewhere around 12 to 18 grand a year of just unnecessary taxes that most people don't realize that they're involuntarily paying.
Yeah. Yeah, it's crazy. We see it all the time. So here to walk you through this analysis, so clients can understand, right? And we do this for a lot for clients, each and everyone's own scenario. So if you're interested, we can run this for you as well. But the fun part is showing what tax, long-term tax we're getting rid of here. And that was the case for this client where we completely got rid of everything they had left in tax deferred being this 584,000 amount. So we got their account value, we give it a growth rate, and then we give it a tax rate about where they are today, at least marginally. So in this analysis, it kills everyone off at age 90, right? So really the next 27 years is the tax burden they've saved themselves from. And so here on the left, right, this is if they didn't do any conversion, just kept these accounts, you've seen this first row here, the taxes paid at the time of withdrawal on RMDs, right? So they now will never have to pay $417,000 of taxes on their first RMD, which for this client's at age 75, right? So they'll no longer have that tax of RMDs. That is forever gone because they now have everything in a Roth IRA. Beneath that, right, they'll never have to worry about reinvesting that into another taxable account. Let's say of an RMD they don't spend, which we see all the time for clients. Or they don't say, hey, we don't need it. I have pension, I have Social Security, I have real estate income, don't need it. And so they go put it in a brokerage account and it gets hit again. And that's what this row is showing. So that 200 grand is now out of the picture of taxes. Again, they'll never pay. And then lastly, if this client legacy was an aspiration. And so a big thing why they want to get things converted was they didn't want to have any of this legacy, 10-year provision spend down to their legacy. So now when they pass, in this case at age 90, they'll never leave 502,000 of potential tax risk to their legacy here. So all in, they got rid of not just getting 177,000 of first year tax savings, they got another 1.1 million in change over the next 27 years of RMD taxes they'll never have to pay. They're now what we like to say, Dad, is you've coined a tax-free retiree to some of those points. No IRMA tax, no Social Security tax, or to the point of surcharges on that Social Security. They're not going to have any RMD taxes, right? And so this didn't happen overnight for this client, but it happened in a couple year process. And we really get excited in helping clients achieve what this client's gotten the status of, again, that tax-free retiree.
Yeah, so we make it real simple. Go to taxessave.com. That's taxessave.com. You'll see right as you open the site, there's going to be a, kind of a square button with, red button with a red square, I should say, with a white arrow. Click it. It's on demand, and it's invest about 20 minutes and go through specific case studies, right, of clients that we've helped, just like this particular client. And then the other thing that you can do is scroll down mid-page. In the upper right-hand side, you're going to see three lines. And by clicking those three lines, it's going to actually take you into these various case studies that are all labeled differently, self-employed, W-2. So don't give up your W-2 listeners. A lot of people are told when they're W-2, oh, well, there's really nothing you do to save taxes, where you should never do Roth conversion because you're a high income earner. That's bunk, folks. We can dispel that misconception all day long. So look at these case studies and then click where you have the opportunity to get your own personal tax savings optimization plan, where we break it down specifically to your scenario. So, A, you learn the tax risk road you're on. Then we can teach you the reroutes and the redirections of the tax risk that can be eliminated and get you on the path to a low tax or a no tax retiree. Again, very simple, straightforward, to the point. Taxessaved.com, taxessaved.com.